We've been looking at the project finance market for some time now. There's been some recent data. They're talking about project finance volumes being down by around 30% year on year. That's quite a substantial drop in the amount of project finance, but it's tied directly to the reduction in the number of deals that have been taking place as well. What we're seeing at the moment are banks retracting. What the positive or the upside is that this retraction in project finance from the banking side is creating opportunities for other potential lenders to infrastructure to enter the market. And we're seeing, it's still early stages, but we're seeing some embryonic activity in Europe in particular, with institutional investors, that's pension funds and insurance companies, looking to put money into infrastructure. When you look at markets like the US and Canada, been a long history of institutional money finding its way into infrastructure debt. But in Europe, it's very, very nascent. If you look at particularly the BRIC countries, if you look at Brazil, a lot of the infrastructure debt that finds its way into the projects in Brazil come from the state-owned development bank BNDES, and they finance up to 80% of Brazilian infrastructure. So you've got a very strong linkage between the government on one hand and the infrastructure finance that's taking place on the other hand. And if you go through markets like China, you find something very similar. Russia, many state-owned banks are lending to infrastructure and governments guaranteeing that. India, the largest project finance lender over the last couple of years has been the State Bank of India, again a government-owned institution. So what we tend to find is when you're moving into these emerging markets, it's either state-owned financiers, either directly or indirectly state-owned financiers putting the money up for infrastructure, or sometimes, depending on the market, it may be export credit agencies. They're a very, very different dynamic to what we're seeing in the more developed markets. And I expect the wholesale development of long-term private institutional debt markets in some of the emerging markets is still several years away. One of the challenges that I am seeing for many of the investors and lenders to the debt products in private infrastructure is that in the more developed markets, the returns that they can make are exceptionally low. And it's all a function of very low interest rate environments in some of the developed markets. So what we are seeing is we're seeing increasingly investors looking to emerging markets to see if they can get a yield pickup, i.e. they just make more money for the same amount of investment they make. The risk clearly is that they're entering into currencies that are not the dollar, sterling, euro, or one of the more established currencies, so they are taking some currency risk. And also they're taking economic risk on those countries. Some of them are stable countries, but others growing very quickly. And as we've seen in one or two emerging markets over the last year, they contract pretty quickly as well. So it's a risky proposition. Since the start of the global financial crisis, we've gone through a couple of difficult years in infrastructure. But given the demand for private finance in infrastructure, we're going to have to find a solution. And that solution is definitely going to lie in getting pension funds and insurance companies to buy up more of the project finance debt.